This week, two of the biggest names in the industry both came out and said the same thing at the same time. Michael Burry just shorted the market again, and Ray Dalio, the guy who runs one of the biggest hedge funds on the planet, went on a podcast and said, "We're sitting on a bubble that looks a lot like 1929. Both of them this past week. You're going to hear a lot of folks talking about this on YouTube, but here's the thing. They're both looking at AI as the trigger. And I think there's another black swan nobody's talking about that'll pop this bubble. So let's get into it. Fun fact, as of right now, the U.S. Strategic Petroleum Reserve probably sits at around 300 million barrels. That's the lowest it's ever been since they started the SPR. Wall Street is currently freaking out about a lot of things, but this is the trigger that's going to flip the market. Okay, so Michael Burry, if you don't know the name, he's the guy from The Big Short. He called the 2008 housing crash years before anybody else believed him. As of this recording, on August 4th, he put out a post saying we're near a major top. And it's possible we get something like a 1987 style crash. If you aren't familiar, the market crashed over 22% in a single day in 1987. He's not just saying it. He put real money behind it. He shorted Oracle. He bought puts at 144.63 a share. And he added a new short position on a company called Nebius. He's also still short on Nvidia, Micron, Palantir, and Tesla. He's been bearish on an AI trade for a while now, and he's not backing off it. He's adding to it. His whole argument is basically this. A lot of these AI winners right now could turn into what's called future ghost towns. Once the current chip shortage eases up and the pricing power goes away, essentially he's saying the boom is real, but it's not going to stay here forever. And the market's pricing it like it will. Now, I want to be clear about something. Burry's trigger here is AI valuations, tech stocks. That's what he's shorting. That's what he thinks is overpriced. He's not talking about oil at all. Keep that in mind. Same week, totally separate thing, Ray Dalio goes on a podcast, Diary of a CEO, and says he thinks we're in the early stages of an AI bubble. Not just any bubble. He's compared it directly to 1929 and 2000. Those are the two of the biggest crashes in modern history. But here's the part that actually matters for what I want to talk about. Dalio said it's looking likely that the new Fed chair and the Fed itself are going to be biased towards cutting interest rates. And his exact point was that doing that would be supportive to prices. And it would inflate the bubble even more. In other words, the guy is saying the crash comes, but then the money printer turns back right into it. Now that hasn't happened yet. As of this recording, the Fed's held rates steady for 5 meetings in a row. Dalio is predicting the pivot. He's not reporting something that's already happened. Yet. He also made a point that kind of stuck with me. He said wealth is not the same thing as money. His example was a company raising $50 million, getting valued at $1 billion, and suddenly there's a paper billionaire. And not a single $1 billion was ever changed hands. He's pointed at Anthropic and OpenAI, both filing for IPOs that could value them over $1 trillion each, as exactly this kind of thing playing out right now. Same caveat as Burry, Dalio's trigger is the AI trade. He's not talking about oil either. So here's where I want to bring this back around. Both of these guys are the two most followed people in the industry. They're watching the exact same thing, AI valuations. And I think they're actually right about the mechanics. Crash, then print. That's the shape of it. I think they're both starting in the wrong fuse. Remember how many barrels of oil we have left in our reserves? Well, last reading was 10 days ago. at 304.8 million barrels, which means we have drawn even more in the last 10 days. So we're probably sitting around 300 million barrels or less. But that's not really the number that matters. There's an actual floor to this thing. 273 million barrels. That's a legal minimum plus the operational budget the Department of Energy needs to keep this thing running. So if we do the math, 300 minus 273, that's about 27 million barrels of cushion left. Out of a reserve that was holding over 700 million barrels, we're close to the actual bottom of the barrel. Now, I already did a full video breaking down exactly how this reserve got this low, why the drawdown rate itself is telling on the government, and why this is a bigger deal than the headlines are treating it as. There's a card in the upper right or left right now if you want to go watch the whole thing. There's also a link in the description below. But here's what's new since then. Saudi Arabia's two most important oil facilities got hit by a missile. Abqaiq, that's the world's largest crude stabilization plant, the place that basically has to touch every barrel of oil the Saudis export, has been taking direct hits from the Houthis. Satellite analysts looking at this thing are counting 4 to 6 processing units with visible damage, 2 that look outright destroyed. That's not Aramco confirming it. That's people reading satellite photos. But 2 separate analysts landed on the same count independently. So it's not just one guy either. As of this recording, there's still no official restart date. The Jazan refinery processes about 400,000 barrels a day. Also got hit, shut down completely. There's a target to get that back up around August 15th. But these numbers aren't confirmed by Aramco directly. And that's an outside estimate. It could slip, and they could be targeted once they are fixed. And then there's the Strait of Hormuz. It's been effectively closed since February. That part I hope you already know. What's new? Iran's parliament actually is reviewing a plan right now to formalize a ban on U.S. and Israeli-linked ships from the strait completely and charge everyone else pretty much an unrealistic toll. That's not, we closed it because we're at war. That's, we're putting up unrealistic boundaries, knowing every country has to reject it. The U.S. has already rejected the plan, but that tells you this plan to open the strait is currently just a delay tactic. And I don't see traffic passing through unless something truly forces an agreement. So you've got our reserves, basically the floor. You got 2 major processing facilities offline with no confirmed restart date. And the country controlling the Strait of Hormuz trying to turn a wartime closure into a closed unless completely desperate situation. That's not an AI valuation story. That's a real-world supply story. And it's sitting right next to the AI bubble that everybody's watching. So let's put it all together. Burry is telling you the crash is coming. Dalio is telling you the money printer's about to turn back on if we do crash. I think they're both right. I just think oil, not AI valuations, ends up being what actually forces the issue. And if that's how it plays out, it doesn't really change the outcome. It changes the order of operations. Either the shortage itself pushes the prices up, or the money printing response to whatever breaks does. Real assets go up either way. So how do you actually play this? There's probably many ways to play this out, but I'm going to give you 2 ways. Not because there's one right answer, but because these are 2 completely different risk levels, and you should play this the way that matches your strategy. The semi-risky way, because it involves timing the market a bit, buy oil, buy gold right now. Ride that. Once you've got real gains sitting in the oil side of it, sell the oil. Not the gold, keep the gold. Rotate the money that you just sold in the oil into stocks. I'm not going to tell you which stocks, that's on you. But here's a rule. If they turn that printer back on, you do not want to be sitting on the sidelines when it happens. Ride oil up, cash out into stocks before the printer flips on. Hold the gold through all of it. That's version 1. Now here's the other way. Honestly, this is the version that I'd actually tell a family member. Somebody I don't want to swinging for the fences. Buy some gold, buy some stock, now, not later. If you got the means, buy some real estate too. And keep 10 to 20% of it in cash, really probably sitting in a money market fund. Then, when the drop actually happens, and I think it does happen, you take that cash and you throw it straight into whatever stocks you already like the best. And you're not trying to nail the exact bottom. You're just making sure you've got actual dry powder when everybody else is panicking. Either way, the mistake is doing nothing and just watching it all happen. And lastly, go do some of your own research. Figure out where you stand on this before you do any type of investing. Don't trust me, just a random guy on YouTube. Investing isn't a sure thing, and sometimes you'll most likely definitely lose money. And as always, good luck. Take care. Bye-bye.